they can't afford to pay their rent and delinquency's starting to spike, that's a problem, right? They can't keep a roof over, like food and shelter, the two major components. And so this like, slow moving train wreck of like, I think we've been in a recession for longer than what.
Welcome to the Yacht Captain Investor Podcast. I'm your host, Scott Kidd, where every week we dive deep into conversations with real estate pros, business owners, and maritime professionals about their mindset and journey to success. Please help support us on our journey and our channel by liking, subscribing, and commenting below so we can help you on yours. My name is Scott Kidd, the Yacht Captain Investor Podcast. Today I have the pleasure of having a friend of mine, Reed Goossens, on. We have one thing in common. He used to work on yachts way back when, before he took the apartment world by storm. How you doing today, Reed?
Good, mate. Good. I was just a low paying deckhand, but it was a good early 20s living in the south of France experience. So yeah, it's we're just reminiscing offline that we got. I was catching up with a good Aussie mate of mine who's a captain as well. So it's brings back a lot of good memories for me.
Yeah, I can imagine. I mean, we all started there, so there's not many of us that made the jump, came from another industry and came up pretty quickly. But for people that don't know you, just give yourself a quick intro so people can find out about you.
Well, my name is Reed Goossens. I'm the founder of RSM Property Group. Been living in the US since 2012, and over the last 10 years, we've done about 27 different syndication deals to date, and we've been active in the industry. Came up through the Change in the Jobs Act, and been proud to be a part of this really sort of golden decade of multifamily. Looking back at it, so we've had a few challenges in the last couple of years. The rough seas, as the excuse the pun, but I'm sure we'll get into the nuts and bolts of it.
No, that's fine. That's making the transition. You've been doing it for quite a while. So what are you currently working on?
Got 2 deals and 3 deals, I should say. We just closed on one, so that's one of the 3, and then we've got one right now which extending for 60 days. Unfortunately, we've got to transition from we're going in a better direction. The asset's doing better. We're going from bridge debt to agency debt, and then we've got a third one coming up thereafter. So been pretty active, but it's been a tough couple of years, and it still remains to be tough. So it's investor sentiment sort of down, and given what's everything happening in the economy, so it's been tough, but we're still getting to the closing table, which is the most important part.
Yeah, that's really important. I mean, it's the investor sentiment for sure is a little bit. The political environment, things, economics generally don't like instability. And a lot of people don't know where to turn these days. But this too will pass. But if we're not in there grinding, it doesn't happen. So,
right.
Explain to people what some of the struggles are you've had in the last couple of years that they could maybe get some help with.
Yeah, look, I think in general we've all seen a shift since COVID. COVID was very much a black swan event. How it specifically impacted multifamily or just real estate prices in general or asset prices in general is that we had the lowest interest rates in I think nearly 2 decades, and it was great. And then COVID hit, right? And then forced to stay at home. Then all of a sudden, stimulus money was printed, and a lot of people had cash in their pocket, right? $4 trillion or whatever the amount is was in circulation. That got really frothy. People's rents went up overnight by doing nothing, right? You wake up and people don't want to live with one another because of COVID, so they're going to move out from mum and dad or their roommate, and they 1 bedrooms, 2 bedrooms were a premium, and you wake up the next day and you could rent the apartment for $400 more than what you probably previously could rent it for, and that's because of the stimulus cash, And then that spurred obviously inflation, and inflation then started to hit really hard, and then the spigot turned off, and then all of a sudden rents fell. You got to couple that with with low interest rates and a demand for housing, there's a lot of new starts, a lot across the Sun Belt. A lot of people were moving that way. So that meant we've had the most deliveries of apartment buildings across the Sun Belt since the 70s, I believe. So low interest rates, high demand, COVID, money in circulation, a lot of supply. It was sort of looking back, the perfect storm, and now asset prices have fallen between 30 and 40, maybe even 50%, depending on where you're at. So it's a very good time to be buying right now. But those values in assets have gone down dramatically, and if you can, hang on with. A lot of people did bridge debt on their properties, and those interest rates went to the moon, and they maybe not had a rate cap or whatever it might be. They're now paying more for that to service that debt, and that becomes a struggle. And there are people handing back keys right now in the multifamily space and in the office space as well, because office was hit really hard. But yeah, I'll pause there because there's a lot of things we can talk about. But there is silver lining in my mind.
Yeah, me too. I mean, with what goes up must come down. Some can't stay great forever, and just the big reset that we're seeing now. We're seeing, in many different asset classes, and it just seems like since COVID, we've been in sense of a kind of a. I don't know if I have a better word, but kind of a funk. Like some parts of the economy are doing well, while other parts are teetering, and then it just kind of keeps moving around the economy slowly. So we're having and now it seems to be that multifamily and some parts of real estate are that's happening. But for the most part, most of the loans are pretty good. So it's a small segment of the economy. It's just a lot of people that bought in the last 2 years that seemed, and in the areas that your markets that you're focusing on, what are you seeing there? I know you do some in Texas. Are you seeing some stuff fall out, like some loans not being able to be restructured and things like that?
Yeah, no, there's been a lot of extend and pretend from lenders because they've learnt from 2008 that they can't just go and default. But it's been a bit of a barren wasteland, to be honest, to try and get deals done. And I remember the beginning of 2024, everyone's like, this is going to be the year that the dam wall finally cracks, and it sort of was another really slow year. Not a lot of sales. I think if you look at the data back in 23, 24, there was up to 70 or 80% drop in asset sales. Just nothing was available. Will say that those early extensions that people got usually kick the can, 1-2 years, and now we're in 2025, and the whole idea was, survive to 25. And now we're in 25. Might have to survive to 26 or 27. So, but
only it doesn't rhyme.
Yeah, exactly, it doesn't rhyme. And so I think you are seeing. I know you're seeing people handing back the keys. Investors are getting wiped out, and it was just a really frothy time. But why do we think today is a really good time to be buying? Well, just look at the fundamentals. Like, out of all the things you can time in investing, the hallmarks in real estate per se, you can time that market a little better because you can still look at where asset prices were versus where they are. Like, you can't do that as much as in the stock market because the stock market it changes every day. Its valuation goes up every day. Where in real estate, it's not a stock ticker, so asset decline can happen more gradually. But then you look at the demand side of it. We're still seeing the silver lining is that you asked me the different areas we're in. Well, Phoenix, for example, we're invested heavily in Phoenix. We saw a big supply hit the market in 23 and 24, upwards of 29,000 units in just last year. 28,000 of them got absorbed really quickly. And now we're on the tail end of, and we saw in our data from managing our assets that our rents plummeted in late 23, early 24, and bottomed out, and vacancy really spiked at the end of 23, early 24. Now for the last sort of 12 months, we've been at 95% or above, less than 2 to 3% delinquency. And so that's a market, because Phoenix has always been in the headline of look at the growth. Another market we're in, Austin, Texas. hasn't had, it was sort of always 1 and 2, Austin, Phoenix. There was always sort of talked about as the darling children of the post-COVID world. But Austin hasn't recovered as well. They've got still a lot more to absorb. Now, the good news is that most of these Sunbelt markets that had a lot of supply hit them are coming to absorb. Either they're through the peak of that absorption, or the peak of that supply, I should say, and are on the backside, or they're going to be within that peak within the next 6 to 12 months. So Austin has probably is lagged, say, compared to Dallas or Houston, but Austin has been hit hard. And there's, again, just two different markets, tales of two different stories. And the old saying is, history doesn't repeat itself, but it rhymes. There's some things in there that we're going to learn looking back at this time over the last couple of years, and we'll make better investment decisions moving forward.
Yeah, most definitely. I mean, I would say Austin's probably got a little ways to go. I was surprised at the amount of stuff that came online in Dallas recently in the last couple of years. That most of that got absorbed as well, and that was all northern Dallas. This is such a huge area because we're working on building out our fund for several development deals in southern Dallas, I-35 corridor, and people always ask, like, what about all the product that came online? But most of that got absorbed, and there's not a whole, because of the way the rates have been, there's not a whole lot coming online over the next 2 years. Permits are down, transaction volume is down, as you were stating, for the last couple of years. I mean, going forward,
add tariffs into that now.
Yes.
It becomes even harder with building new supply.
Yes,
which is only going to, and interest rates remaining relatively high. Your conversion of those folks that would get out of the renting pool and into buying first homes is limited, right? Like, I have a house where I locked in back in 2022 a 2.99% interest rate. The person today on the street trying to find that house is paying upwards of 6.5%, 7%, right? So it's, you got to now pay more. So people are renting for longer, and yet there's not a lot of supply. So we think we collective industry thinks that there's going to be, positive. We're starting to enter into a positive rent growth territory where we've had a lot of negative rent growth. And if you look at the graph, right, I vividly remember thinking, and this goes back to lessons learned, like, when you've got a lot of stimulus money in circulation and people are paying, I don't know, $1,600, $1,700 for a 2-bedroom in a class C plus B minus asset, when that stops and the rent drops down to $1,300, $1,400, well, maybe it was always supposed to be that. It was just that blip in the radar because of how much money was in circulation. So depending if you made an investment decision at that time and say, I can bring all the other units up to that level, well, when the rents drop, that's when obviously your business plan goes out the window. So I think we will look back at this time and probably see that blip in the radar, but by and large, 30,000 foot view, rents will continue to go up as inflation continues to go up.
I think so, just because there's such a lack of supply and just the affordability problem in all these areas that people are, like, as you stated, people are not able to go and buy into a house, whereas usually they might stay 2-3 years in an apartment and then save up to buy a house within 5 years or so. They're probably going to be holding and renting for much longer, if not for the duration of their career. Because I think we've come off of that peak of 69% owned their own home. I think that's well down, probably around 60%. But I'm not quite sure. But it's going to be renting. People are going to be renting for longer, especially with not much supply coming on. I think you're exactly right that the trend is going to be an upward, but it's going to be slow because real estate's always a lag indicator and slow moving, especially commercial real estate and residential multifamily.
I would add to that there's also an element that, particularly in workforce housing, it's a good litmus test to see how delinquencies, like we saw a lot of delinquency spike in, as I said, right after that, when that money sort of turned off for a good 6 to 12 months. And everyone look at the stock market for a barometer of the economy. The stock market has 25% of Americans are invested in the stock market. The real economy is probably at the data we're collecting on site and saying, well, hang on,
people doing?
Well, if they can't afford to pay their rent and delinquency's starting to spike, that's a problem, right? They can't keep a roof over, like food and shelter, the two major components. And so this slow moving train wreck of I think we've been in a recession for longer than what maybe was, sort of put out into the world. I'm not an economist, but just by looking at the data that, the average, with the groceries have gone up, the cost of living's gone up, and then I keep pointing back to that delinquency rate. It is now stabilized. That's the good news. So I think we've got through the worst of it. But inflation and the fears of inflation or fears of tariffs or fears of whatever of a recession are still lingering. Part of me believes it's we've had this, again, it's like a slow moving train, sluggish, sort of feeling. I won't say it's an economy because I can't point to data. And it's kind of like, let's just rip off the Band-Aid, and if we're going to have something bad, let's just have it already and then get on with it. Stop prolonging this pain. Let's just have it and be done with it. Because if you'd had it earlier, we might have already been through it by now. You know what I mean? So
I would agree, because it was 2019 October was when the yield curve inverted, and then usually that's within 6 months, and within 6 months that was February.
COVID hit,
and then they just dumped a whole bunch of money into the economy, 4 trillion, and they're spending like it's like drunken sailors, to inject my own pun into it, but.
But in general, it's we're going. But I think it's also been the other element that we haven't spoken about, which is a big element that we need to speak about, is real estate has by and large been a bit of a dinosaur when it comes to tech. Right now, you look back 10 years ago when I first got started in 2014. The coolest thing since sliced bread was get an investor to sign via DocuSign. Right today, I can go online, and with the use of AI, I can see within a mile of my property what a 1-bedroom rent's for, what a 2-bedroom rent's for, and I can get, I can generate a P&L within a click of a button. And so the barriers to ambiguity that we saw early on, after the 2008 recession, at least in my early career, was a lack of access to data. And I think that's also played a subtle role in people jumping into the business. It lowers that uncertainty of what's the access to data, what are you renting for, what are your expenses, and all that sort of stuff. So I think that has played a pretty major impact in how we lease, how we operate, how we run financial models, and it is for the betterment of the industry, but it's lowered that barrier, and thus there's a lot more people, in the pool, so to speak.
Yeah, there was a lot more people came in when everything was booming and people were turning over with all that money circulating. People needed to put money in. It was very much easier to raise capital because there was so much floating around. People had to put the money into something, and I would agree with AI and everything. It's just raised the efficiencies of a lot of things. Like you could put the entire apartment building, all the ins and outs, the whole manual in AI, and have a chat bot where everyone has the app and that's a resident, and they can ask questions, and it's a automated AI chat bot that answers all their questions. You don't need that extra person that's going to be answering the phone 24 hours a day. And that's just one example. There's so many other ways, smart locks and all these other things where you can control the entire building,
Yeah, and I'm just more talking about that's the on-site stuff. I'm more just talking about the access to data to compare yourself, to produce a P&L, to produce a pro forma, to then go, okay, I'm willing to pay X because of all this data that, again, 10 years ago wasn't readily available. And so that's been a big change in my, I'm only 38, so I'm, I haven't been around forever, but it has had again, COVID, stimulus, low interest rates, inflation, technology is, one of the five.
One of the major things.
One of the major things.
And I would say, just even with, Yeah, it used to be you had to pay a lot of money for this data. CoStar is pretty expensive still.
Right.
But now a lot of you have so many other apps that you can analyze a whole area so much quicker and easier within a matter of minutes rather than hours, or
Correct.
having to go down to the city and go and look at plans and everything else. Those things are, I think it's only going to get better. All those efficiencies are going to be, very, very soon. You're going to have some type of AI bot analyzing everything pretty quickly. And I think people are already building these things out. But, it would, what do you see like over the next couple of years, especially with AI and stuff? What do you see some advantages of using this, and where do you see that fit plugging in?
I think
in your business.
You hit it on the head. So let's see where I fit in my business. It fits in my business with marketing to investors, creating access to data from comps and expense comps and all that sort of, keep my property managers honest, keep really the front end of the funnel when we're looking for deals. I think is really efficient, creating models, creating investor decks. On the physical side and the how you interact with tenants, I don't see yes, the Class A, downtown Manhattan, downtown Miami, downtown Austin, very limited hotel-esque type of check-ins. There's not many humans. It's more computers. But the vast majority of people that we deal with are working class folks. They still want to interact with someone. They still want to come into the office and talk to someone and do a maintenance request. And so I think it's on the front end with, as I mentioned, all the sort of the analytical stuff and the investor facing stuff is really powerful. On the physical side, it's helping, but it will never replace warm bodies in my, I'm going to halve my payroll because I've got this bot.
Yeah.
I don't think that's, I prove me wrong, but again, with workforce housing, it's just not inherent. We still have people who sometimes don't have bank accounts, So they
want to pay cash.
Right. So they don't have a smartphone. So there's a lot of folks out there still like that. And so I think it's all well and good, but I don't think it's a tool in your business, not necessarily the doom and gloom. And the other thing we've got to also understand is, as a leader of companies, we've got to make sure that we encourage our staff and our property managers to try and use cutting edge technology to find efficiencies. And, I'm no expert on AI, but I'm sure curious about it. And so I'm going to constantly keep asking those questions. How's it going? How can we get better with leasing? How can we get better with, collections? Or how can we get better this, and that? It's all going to be using AI to sharpen that weapon, or your tools, I should say, to do your craft better. But it's been, I use ChatGPT all the time. It's bloody brilliant right now. So
I would say I use the same, and I've gone down the rabbit hole of getting apps, and because some of them are pretty incredible, so I kind of have to stop myself sometimes. I used to be in tech, and some of them you can nerd out for hours with some of these things because they're pretty impressive. And there's a big concern that people are going to be replaced, but I think it's like you said, it'll only make people more efficient, and you may get replaced by somebody that's more efficient than you, but that's the job market anyway.
You're not going to get that sign on the building in Germany. Hey, ChatGPT, come and finish this construction. If there's a leaking tap or a leaking toilet, AI is not going to do it. You still need someone to do it, right? It's going to be
robots.
It's going to be in the margins where people are communicating. I think it just as you submit a maintenance request, or as you are looking to prospect for a new tenant, those are the sort of things that
those processes, it's going to optimize a lot of those things. You can, because I knew people that were using with their Airbnbs and storage facilities where everything was kind of made more efficient because you had all the smart locks, you had whereas you don't have to go and bring the key to them or anything. You got a lockbox with the keys, and you can change the code every time it updates, anytime somebody leaves, and you have the whole prospectus with everything in there where they can just get on the app and find out, and to where they don't call you all the time and stuff like that. But I would say that it's only going to get better, and we're going to take the good with the bad, like we do with everything else. I mean,
Right.
And what would you say the biggest lesson you learned over the last period?
I think making an investment decision based on numbers with inflated rents has probably been the biggest lesson I've learned. And where did that come from, i.e. stimulus? I'm again not getting political or whether it's right or wrong, but it was when you've got a snapshot in time and you then think, okay, my pro forma is going to continue going up from that point. Mm-hmm. I think that's the mindset that we got into, too frothy. And there's a lot of big players out there that are handing back keys, and so I think
that's for sure.
I think in general, with no one saw the people could say that you could see it, but I didn't know.
You see it now, but
you can see it now.
You didn't see it then.
Yeah. Like
no one was talking about it. No one was saying.
No one's saying. It was a knife fight to get deals done. $1 million hard day one. It was so frothy.
Snooze, you lose. Everything was like that. You like you said, $1 million hard day one, and then people were doing higher projected rents, and now I've seen a few where they're flatlined or they're negative rent growth for a couple of years, and I always see people tossing around that word conservative underwriting, but that's usually like everyone can say that, but at the end of the day, they're trying to make it, it's all relative, and it could be, that's conservative to you might be a high risk to me, if it's projecting, negative rent growth, I would say that's probably pretty conservative, but that could be kind of right on with what's going on in that area too. I mean, each local area is going to be something different, is there as far as going forward, what do you have on the books for your company and over the next few years, next 5 years or so?
Look, I think we're going to continue to do our sort of 3 to 5 deals a year. I don't think we want to get outside of that scope. We're looking to add other investment opportunities in the M&A space. We're not the operators, but we're providing investors something different, because I think that's kind of it's been pretty quiet out there in terms of, multi was the shiny bright new object a couple of years back, but today it might not be. Now, we think it's a great time to be buying because there's a lot of distress, and I think we could look back at this time and say, well done for picking up, half a dozen to a dozen assets. But if you don't have the investors who aren't interested, it's going to be hard. It's hard to raise money. So I think it's just, as a company, we're also looking at ourselves and like what we're trying to offer. And I think we're always going to be multifamily operators, but having maybe a couple other 1 or 2 more offerings in other spaces to maybe more yield producing is going to be where we think there's some opportunity lies. But in general, as I mentioned, we are still going to remain. We've got more deals in our pipeline today than we've ever had in the last 2 years. Like we can't raise enough money, so it's a really good time to be buying. And it's just you got to look at 2 things: is it a distress operator or a distress asset, or is it both? And you don't want to be buying a distress asset. You want to be buying it from probably maybe a distress operator, and we don't wish that upon anyone. But it is the reality of where we find ourselves in today.
Well, I would agree. I know in talking to a lot of the investors all the time, fund managers and stuff like that, they want cash producing. Some of them have moved into like cash producing businesses and stuff, and I think that's a good move to give the investor something else, because multifamily is not for everyone. And all things are not for everyone. This has been really great, and really appreciate you coming on. How would people find you or get a hold of you if they wanted to learn more about what you do?
Yeah, look, easiest way is to head over to www.rsnpropertygroup.com. That's Reed, Sophie, Nell, Property Group, singular.com. I'm across all the social medias, Reed Goossens at LinkedIn, on Instagram. Just hit me up. And if you're ever coming through Los Angeles, you want to grab a beer or coffee or talk shop, you can hit me up at reed@rsnpropertygroup.com.
Well, that's been great. I really appreciate you coming on, spending time with us, and sharing your knowledge and your extensive experience with everyone. I really appreciate it.
Thanks a lot, Scott.
Well, this is Scott Kidd with the Yacht Captain and Investor Podcast. Just reminding you that your best investment is investing in yourself. See you guys next time, and I'll talk to you soon. Thank you.